Hey there guys, how's it going? Welcome to the FTSE show with me, Chris Chillingworth. This is the show where we look at different FTSE stocks. We look through the finances of these different companies to identify the best growth stocks from the FTSE 100, the 250, the small cap, the fledgling and even the FTSE AIM markets. So we're slowly improving the show. I don't know if this is going to come through on the video or not, but we have invested in some lighting. We've got some massive lights in front of me now. I haven't mastered placement of lighting and shadow displacement, all that kind of stuff yet. So you're going to have to, bear with me as we improve the quality and the production of the show, but we're working on it. But I think the content is more important, and I've always been a big believer that the content is the most important thing. But we are trying to improve the production as we go. So I had some feedback from previous shows as well, and so you will notice that we tweak things a little bit as we go. The way I see it is that the show is going to evolve, but there's been some people who preferred when we were looking through the actual spreadsheets and going through the numbers. The reason we shifted away from that was because I was getting so many emails from people saying it's pretty boring, just stuck behind the spreadsheet. So obviously you can't please everybody. I'm going to do what I think is right for the show and stick to the current format that we're doing, but we'll make some tweaks along the way. One thing that I am going to introduce in today's show is we're going to look at the charts in a bit more detail because I feel like there's more value there to be provided. But yeah, so without any further delay, let's dive in. Okay, so episode 6, we are going to look at a company today called Bodycote. They are a FTSE 250 company in the industrial metals and mining sector. The subsector is Metal Fabricating, so it gives you a clue about what Bodycote do. Epic code is BOY, boy. And no particular reason why I picked this company. I just started going through the numbers. Basically what I do is slowly make my way through every single FTSE stock. There are still companies that I've not got around to even looking at yet myself. There are hundreds and maybe even thousands probably, once you include the AIM markets, of stocks to analyse and go through. Slowly making my way through those. But we've got through a couple of hundred now so far, and the FTSE 100 market has been pretty much covered right now. We're still starting to go through the small caps and the fledgling markets and even the AIM markets. So we're looking at BOY, Bodycote plc then today. First thing I'm going to look at is revenue. So are we seeing revenue growth with this company? We go back to 2008, they were bringing in about 551 million revenue. By 2011 that was 570, so pretty much the same, not really going anywhere. 2012 was 587, then we saw a bit of an increase up to 2013 where we reached 619 million, but we're still not a million miles away from 2008. And by 2015 we were sitting at 567 million. So Bodycote has pretty much stayed level until 2017 and 2018, where revenue started to take a bit of a spike. They brought in 690 million in 2017, and then in 2018, the last report that we've got access to, 728 million in revenue. So the last 2 years have been a bit of a spike in the right direction there. So we do have revenue growth, but from 2008 to 2016, really not much there going on. It was pretty much flat every single year, around the same kind of ballpark figure. The last 2 years is where we've seen some growth, but there is growth there, so that's cool. So looking at expenses, this is the costs of doing the business. So it's not necessarily the cost of the materials coming in that they've got to then use. We're talking about the actual running of the business. So we're talking about wages, we're talking about staff costs, we're looking at advertising costs, marketing costs, rates, rents, that sort of thing. We have pretty much got flat expenses in so much that over the last 5 years, from 2014 to 2018's report, we're looking at about 82% pretty much every year. Maybe we've seen it go down, I would say maybe from 83 to 82%, but pretty much we are flat on the expenses. That's all right. That's not too bad. That means that it's under control. It's certainly not going up, which is a big problem when expenses are going up. That means that the future outlook may not look so rosy. But flat expenses, especially over a long period of time, gives you a bit of security and kind of gives you an idea of where this company is going to be in the next few years. The expenses rate, so the 82, 83% is quite high. It doesn't leave the company with much in terms of operating profit. And so as a result of that, if they've got high debts or anything like that or high taxes, they're going to struggle a bit. Looking at R&D and depreciation, we don't really have any issues here at all. We can look at the interest on debt. Now, this is a good story in so much that back in 2010, this company was spending 12.3% of their operating profit just on interest on debt alone. Down into the last year, that's gone down to 1.6%. So we've seen a decline from 12 to 1.6% over that period of time. Now, really, it's kind of stayed stagnant in the last 5 years. So from 2010 to 2018, we've seen a decline. But actually, in the last 5 years, that decline hasn't been quite so dramatic. We've dropped down from 2014's 3% down to 2018's 1.6%. So there is reduction here. There is a reduction here, and that's a good sign. In terms of the actual percentages, absolutely fine there. Really no issues with 1 to 3% of the operating profit being spent on interest on debt. That's well within the regions or the limits of what I'd be looking for. So far, things are looking pretty good. We've got growth in revenue over the last couple of years and stable revenue prior to that. Expenses are pretty much stable, solid, flat. Not really going in the wrong direction for sure, and at a level that's a little bit too high, but okay. Interest on debt, not a problem. That's all at a level that would be fine. We would agree is acceptable. So we move to net earnings. This is the slice of the pie, the slice of the revenue that's left after all the deductions. We're talking about taxes gone, the expenses gone, the interest on debt being taken out, the depreciation, the R&D costs, all of that kind of stuff's been extracted out from the revenue. What's left for the company, what's left for the shareholders in terms of profit. Okay, so over the last 5 years, we have seen a slight increase. We've gone up from 13% to 14%. There was 2016 where the company saw a bit of a drop off down to 11%. But overall, that's a really healthy figure. Any company making 13, 14% net profit is doing pretty well. That's pretty good. And we're happy with that. And the fact that it's gone up as well, ever so slightly, by about 1% over the last 5 years, again, it's a good sign. It's not a massive trend. It's nothing to get excited about. But it has been up. It's gone up. And that's very good. And obviously, that's largely down to this massive increase in revenue, but with the expenses staying relatively flat. So more money coming in, but the cost of doing business hasn't dramatically increased, and therefore there's a little bit left at the end of the year, right at the bottom line. So they're making 14% now, which is fantastic. Really good numbers there. So this is really promising start for Bodycote. This is a good start. So then we're going to look at assets against liabilities. So we want to make sure that the company have healthy amount of assets against the outstanding liabilities that the company has. And we want to just make sure that basically the assets outweigh the liabilities, or at least match them. Okay, so we look at the current ratio for that. We're looking at current assets against current liabilities. Current assets are assets that we can turn into cash, or liquid assets, sometimes they're referred to as. Assets that can be turned into cash within a year, let's say, against liabilities that need to be paid within a year. And we just want to make sure we've got more assets outweighing the liabilities so we can cover costs. And over the last 5 years, we've pretty much seen the company stick at about a ratio of 1.2. So that's consistent. Relatively, there's been a little bit of a dip in 2015, 2016 down to 1 and then 0.9. But this is a healthy figure. This is fine. This isn't a concern at all. It's within the green zone, if you will, and 1.2 is perfectly healthy. So no issues there at all. We can look at the debts, outstanding debts. So short-term debts and borrowing. We've pretty much stayed at about 2.5 million, well within the regions of this company. Now, when we look at debts, essentially the best way to kind of measure debt in terms of are they biting off more than they can chew is to kind of refer that or compare that against what the company's actually able to make in terms of profits, right? So the more debt they're carrying, the more profits we need them to be able to make to cover that debt. Some companies are taking on so much debt that it would take them 20 years to pay off that debt based on the current earnings. That's not a good sign. So with the short-term debt, which is debt that's got to be paid within the next year, we're looking at 2.5 million, well within the region of what this company are able to kind of carry. Long-term debt, so debt that's got to be paid over a year away, zero. There's no outstanding long-term debt. They're not carrying any debt there. 2016 they had 5 million, paid that off pretty much the next year. So really solid. They're not really using any debt to achieve the numbers that they've been achieving, which is great. And therefore the interest on debt is going to continue to decline, as there's no outstanding debt right now other than the short-term debt of 2.5 million. So very, very, very healthy. Love the fact that they're not needing to use debt to achieve the figures that they have been achieving. So that's very good. So I want to look at the reserves. This is the pot of cash that the company are either paying into or taking out of every year, and it's accumulative in so much that it accumulates every single year. So every annual report that you read, the figure will have either gone up or down based on what's been added to it. So from the last 5 years, we've seen that pot rise from 233 million to 327 million. Now, as of 2016, it was still at 234. So really, it's only the last 2 years where we've seen some increase in profit, where those reserves have been kind of pumped into a little bit more than usual. And so, you know, that's to be expected. But they're sitting on 327 million in terms of their reserves. It's healthy. Certainly over the last 10, 11, 12 years, when they were sitting on 58 million, the fact that they're now at 327 million means that there's obviously some strong growth there over the last 10 years, which is a great sign. They are also buying back their own shares, not every single year, but there is definitely a focus towards that as well. So most years they're buying back their own shares, which is good because it reduces the amount of outstanding shares out there on the market, and it can drive demand for the shares outstanding, the remaining shares that are outstanding out there on the market, and that can drive share price up. So all in all, really good, really solid. I'm really liking Bodycote. So when we look at return on shareholder equity, however, this is the area where Bodycote don't quite really make the grade. We're looking at about 14% consistently throughout the last 5 years. That doesn't quite make the grade for me. This is a figure that's very important to me, the return on shareholder equity. What return is the company getting from the assets that it's accumulating? So when it's investing the money, the profits, how are the board investing those profits? Are they investing them in dividends? Are they buying assets? Are they buying intangible assets like rights and licenses and trademarks, or physical assets like property, plant, equipment? But more importantly, how are those assets that the company's spending those profits on contributing to future profits? All right, so when we're investing in this stuff, we expect that to make us more money, to make the business more money. And this is an indication, the return on shareholder equity is an indication of how well the board is doing that. Now, 14%, it's average, it's okay, it's underneath where I'd want to be looking at for a company that I'm going to invest in. And for me, this is the only real strong reason why I wouldn't invest in Bodycote myself. The quality of the companies I invest in has to be very, very high. I mean, this gives you an indication. We're looking at a very strong business here in Bodycote. 14% a year net earnings, right? Very, very solid. There's a company that's making very good profits. We've got growing revenues. We've got no debt. We've got assets that outweigh the liabilities. Everything's looking pretty strong. However, I know there are companies out there that perform and produce better numbers than Bodycote. And for me, there would be no point in me putting my money in Bodycote when there's an opportunity elsewhere with producing better numbers. But Bodycote are still a very, very good company. And I think we're going to be up there with Intertek. I think once we crunch the scores, we're going to be up there. Whether or not we're better or below, we don't know that yet. But this is a good company. You know, when we look at the companies that we've looked at so far, this is a company making 14% net profit a year. So they're going to score pretty well. Unfortunately, however, the investment in assets, the return that they're getting from their assets are not as strong as I would like, and for that reason this is not a company that I would personally be adding to my watch list. Out of the 200 odd companies that I've analysed so far, I have 29 of them in my portfolio. So it just gives you an indication there of just how high that bar is that I'm looking to invest. And remember, I mean, this is a kind of a guesswork figure, but we're looking at about 100 points for a company that I'd be really starting to get excited about. I'm not sure Bodycote are going to achieve that with this return on shareholder equity score, but we're going to see. So the next thing we'll do then is let's take a look at the charts. Okay, so here we are looking at Bodycote plc then, the chart of Bodycote plc, epic code BOY. As you can see, these improved financials are reflected in the share price growth. And this is exactly what I have seen a trend in since I started doing this years ago. When I'm finding companies that are meeting the grade financially and they're producing and meeting the numbers that I'm looking for in their annual reports, we typically see share price growth. And this is another of many hundreds of examples I could show you of this. As we can see here, Bodycote plc, the numbers were not strong in 2007, 2008, 2009. Really the growth started, or the solid financial numbers started to really come in 2010. Back in 2010, Bodycote were trading at about £1.50, £1.70 odd, and certainly in the first couple of months of 2010. Today, in 2020, they're trading at £9.28. So, I mean, it's around an 800% growth over the last 10 years or so. So, annualized, you could argue that's going to be something like 70 to 80% a year. Obviously, it doesn't work out like that, scientifically speaking. But if you were to break that down across the 10 years, 800% divided over 10 years, you're looking at about 80% a year, which would be a fantastic stock to have in your portfolio. Absolutely. There is no doubt this is a solid company producing 14% net earnings a year, and they have been doing very well. There have been some ups and downs along the way, but there's definitely a strong trend here. And so essentially a very strong company that I think are going to do very well on the leaderboard. So let's take a look at the leaderboard. Okay, so looking really solid on the charts as well as through the numbers. The next step really then is to see how does this company fare on our leaderboard. They've got to be 84 points to beat Intertek and become the top company. Will they achieve that? Let's take a look. So, going through the numbers, we put the scores and the financial results from the last 10 years into our system, which grades a score for this particular company. And I think the company would have achieved a much higher score had the return on shareholder equity not been as average, maybe even poor, is the right word to use for this company. Had it been better, I think they would have scored, well, they would have scored way better on this, and would probably be a company I would personally be looking to invest in, because it really is the only blemish on the entire financials for this company. And so, BOY, Bodycote plc, who are a FTSE 250 company in the industrial metals and mining sector, the metal fabricating subsector, score a rather exciting 89 points, which puts them at the top. So once again, we've got a slightly better company. Let's just get these guys up on the board. And once again, we're pushing these companies down. These were not good companies. If you've gone through the first couple of episodes of this show and you've taken a look at companies like Royal Mail, like Tate & Lyle, like AA plc, then you will know that these numbers for those companies were very poor in comparison to the companies we're looking at here today with Bodycote. And so Bodycote come top. They are top of the leaderboard right now. This is probably, I think, apt because I think the numbers for Bodycote were slightly better than Intertek, and the score is the same scoring system for every company, right? There's no kind of bias in any way, so we're using the exact same scoring system that I designed to reward all the right numbers that I'm looking for in a stock, right? So if a company ticks every single box that I'm looking for and is producing the numbers that I want in terms of the thresholds I'm looking at as well, in terms of the scores and the finances, they're going to score very, very well on this scoring system. And as you can see, Bodycote and Intertek have been two solid companies, not companies I'm personally investing in. Didn't quite make the grade for me for different reasons, but still very solid companies. And if you were to invest in Bodycote and Intertek, you will probably find they'll do you very well over the next 5 years to 10 years. But there we go. So another company to top the leaderboard. We'll see whether or not they stay there. It's going to be hard pushed to knock them down. There are not many companies in the FTSE that are going to beat them, but there are companies that will beat them. They do exist. And we are going to see some companies hit that 100 mark, I believe, at some point. But I'm going to wrap it up. Thank you very much for watching. I hope you found it useful and entertaining, and I'll see you guys in the next episode. Cheers.